If I bought a Lamborghini tomorrow, then I'd probably have 1,000 people in my mentorship. Something that I find with trading is that it's outside the realms of what's normal. There are very few jobs, like a surgeon doesn't go to work and try and be right 50% of the time. A pilot doesn't go to work and try and land 50% of the time. If you've got an edge and you execute it for 3 years, but you keep failing because you're messing up, okay, that's the point to maybe turn to, why am I thinking like this? If you've got an edge, you just need to execute it. If you start messing around with the edge, you're messing around with something you don't know the results of. Making that jump and suddenly then being fully reliant on trading as an income completely screwed up my psychology.
Daniel Munday, founder of the 3% Club, full-time trader. You're very welcome to the show.
Thanks, Colin. Nice to be on. I enjoy a podcast, so looking forward to this one.
Yeah, and very nice to meet you. I said you now I know deliberately fly under the radar from the kind of typical trader marketing, and you stick to those kind of professional routes, which I admire. But I would like to see you on Instagram promoting the stuff because you're doing it the right way.
It's difficult though, because an equity curve or a verified history doesn't sell. I've talked about this before on LinkedIn. Actually, if I bought a Lamborghini tomorrow, then I'd probably have 1,000 people in my mentorship. But if I post a verified FX book link, then nobody clicks it. So it's just not the market for it. Unfortunately, I think because Instagram and TikTok are get rich quick, and they're driven towards people with low attention spans. Essentially, I think the average TikTok is watched for 7 or 8 seconds. I read, maybe this has changed, but this was a couple of years ago. So you've got to be so patient to be a profitable trader. I mean, realistically, are they the kind of clients that I would want to be mentoring? Possibly not. So yeah, I mean, as much as I would like to grow the mentorship to a certain point, I have also capped it at 50 members because I feel like we've got such a good, solid group of people in there at the moment, and we're all executing together every day. And we make a joke, we reference it at least once a day, that we're the best trading group you never heard of, because we are just flying under the radar with 50 of us in there, and some of the stuff that's going on in the mentorship is crazy. It's crazy.
That's fantastic. And I think that community type way of learning, learning together, seeing someone that's already, I guess, the ideal or the pinnacle of what you should be doing, executing every day. I think it's kind of the optimal place to learn as well. I'm not trying to sell your mentorship here, but I mean, I just
Nor was I.
that's how that's how I learned, and that's how I when I finally things that finally started to work for me was when I could. You're just immersed in it every day.
Yeah, you're so right. I think if you take a week off the markets, or I find if I take a week off the markets, the first day back, I'm sort of like, what's been going on? Where is everything? It takes me that day or two to kind of get back into it and get aligned with everything again. Because you almost go to bed when you're trading full time. You go to bed knowing where pound US dollar is, what the price is, and you wake up seeing if it's the same price. It's the first thing I do when I wake up in the morning. Not necessarily that currency, or that asset, but I would be looking at something the night before. And then today, great example, I was looking at a New Zealand dollar, US dollar short that we took as a group yesterday, late in the session. It came in just before spread hours. And then first thing I did this morning was, where did it go? Did it keep going? Do I have some unrealized gain to log in my data collection here? Or has it pulled back to break even? What's the full result of this? So yeah, it's a full on job, that's for sure.
Yeah, I'd say you did have a gain, right? Because I mean, I didn't check New Zealand dollar, but euro dollar cable. I think the dollar was bid this morning.
Yes. Yeah. So we came out before the Wednesday triple swaps. We closed it at the first kind of H1 area of support. And then it bumbled around that all night. And then the last couple of hours, it's extended to the downside again. So, yeah, we seem to be rotating on the dollar at the moment across the board.
Excellent. Now, the first thing I wanted to jump into really after watching that interview you did online was your kind of mentality. And there was a quote
Yeah.
in that interview. Um, it was, you can have a great system and still fail if your head's not right, which I quite liked. It's just straight to the point. But when you're working with, say, those 50 people in your mentorship or new traders, how do you help people get their head right before they start.
Yeah, I mean, so to give you a bit of a background there, I started the mentorship in COVID when we were in lockdown. And it purely came because a couple of my friends were not at work because a lot of people were sat at home. And that was the time when a lot of people got into trading. But I
Mm,
started in 2012, and it was known amongst my friends that that's what I did. It was my full time job from 2016. And I started to help a few friends and teach them. And I've learned more in that period of time than I learned in the 8, 9 years prior of trading, because I'm seeing it. It's almost like looking in a mirror and seeing all the things I used to do in the new mentees that come in. And some are better than others, there's no question, because it doesn't just come down to mentality, but it also comes down to things like your environment, how you grew up. Was money scarce? Did your dad talk about the cost of everything everywhere you went? Or was money just free flowing and you felt like it was easy to come by? Were you surrounded by people of that mentality? There's so many different elements that come into it. And the system, I think that the system is actually the easiest bit. If you took away my edge tomorrow, I think if you gave me 6 months, I'll find another one, because the way we found our edge and the way I found my edge originally was through data. So it's just collecting data, as I said to you before, doing more of what works and less of what doesn't. That's
mm,
simply what trading comes down to. And there are patterns, or there are things that happen more often than they don't. And finding what those are, whether they win or lose, it's irrelevant, because I've always said if you find a bad trader, a signal seller, for example, and they're useless, pay them 6 months up front and reverse trade them. You've got an edge, right? So you don't necessarily need to find a system that works. A system that doesn't work is equally as good, because you flip it
mm,
upside down and you have an edge. But what I found, going back to your question with then mentoring new traders, is that yes, it was like looking in a mirror and seeing these common things that I used to feel. But if you have a system, or you're taught a system by a mentor, and you know there's an edge there, the way I try to get the new trader to understand that and to execute it efficiently is fall back on the data. So there's this heavy thing within trading where we drive everyone's psychology. I see it on LinkedIn all the time now. Read Trading in the Zone, read The Best Loser Wins,
mm,
focus on your trading psychology. But that means absolutely nothing to the new trader. They don't understand that. They haven't had enough time in the markets. They haven't got any skin in the game to understand exactly what they're having to work on. Thinking probabilities, great. That's great to say. Practically, that's nearly impossible to do without trial and error, right?
yeah,
So
yeah,
the way I've done it with my mentees through trial and error on my part through mentoring is through data. So if they've got data, they can fall back on it to give them conviction in the edge, to know that,
mm,
okay, we lost 4 trades in a row, but this system has a 75% win rate. That's perfectly normal. My data tells me that's normal. I've got to continue to execute, and that will give me conviction, that edge, that data collected, the probabilities, understanding strike rate, and so on. That's a practical way to apply psychology to a system, rather than saying just read Trading in the Zone and thinking
yeah,
probabilities. Anything can
mm,
happen. Yeah, it's all factual. Everything in there is great, but the novice trader is way too early in the journey. Even in the first 5 years, I think to try and integrate books like that into their trading methodology. It's not about the psychology, it's all about the edge for me. So if you've got an edge and you execute it for 3 years, but you keep failing because you're messing up, okay, that's the point to maybe turn to, why am I thinking like this? Do I need to address something within my growing up? Am I holding something back? Is there something I'm doing subconsciously, self-sabotage, whatever it might be? But equally, for the new trader, it's like I just said, it's irrelevant. The edge comes first, psychology comes later on. And some traders I've taught don't have that issue, others do.
yeah. God, you raised a lot of important points there, but I'll go back to that trading in the zone part, because I did read that within my first 2 years of trading, and that was my exact experience. I was like, it's almost like you're reading it and you're getting this kind of dopamine, like, yeah, yeah, that's all correct. but then you close it, and I'm like, I'm not really sure what that means now for me. So it's, yeah, it's understanding that system is a really, really good point. And there's a few people have come to me saying when you have those statistics and things make sense, at least you can calm that kind of monkey brain that wants to just exit the position right now. It's like, well, or increase the risk or decrease the risk or just stop trading because
Mm.
you have that base reference to go off.
Mm. Yeah, I work with a few traders that have their own edge. So I spoke quite recently at a traders summit in London. There was a couple of people in the audience.
Hmm.
They've got their own edge, and they came to me. They reached out to me after because I went really heavy on presenting data. Because you ask me anything about the edge that we trade in the 3% Club, pretty much everyone in there can tell you exactly the expectancy of anything that's happening, the strike rate of a
Well,
certain type of setup, because they've got the data and they've studied it, and they then have that conviction in the edge because of the data. But there were a lot of people in the audience that had their own edge that they hadn't quantified it in any way. So I've sat down with a few of them since and looked at their edge, and I've given them spreadsheets to fill out. Over the course of the week, we check in on a Friday. Over the course of this week, every trade that you take, they have to explain their system to me. But then in their system, what's working frequently, what's not working frequently, what's the average drawdown, what's the unrealized gain of every trade, what day of the week is it, what session is it, all these things. But they weren't recording those. And
hmm.
what you actually find sometimes is that they can 5x their edge if they just did more of what's working and less of what isn't. But because they've never quantified that data, they don't have it, they don't see it.
Yeah. And is it something you, it sounds like you're say writing these entries or taking them in a spreadsheet, but is it something you've tried to backtest systematically your edge and
Hmm. Yeah, more of a fan of live testing because I find, let's take last year, the markets are very different to how we've started this year. We've had tariff driven markets, and there's been a lot of risk moves. All of last year, if you saw a risk move, you would tend to see money piling into the S&P, and Dixie as a result would go down.
hmm,
If you look at this year, you've seen Dixie and the S&P rally together quite commonly because of economic strength or weakness. So that correlation is completely different to what was happening last year. So we could backtest last year's data and we could say, right, this is the edge in the markets this year. And the foundation of our edge is built off of years worth of data, thousands and thousands of trades. But we refine it quarterly. And some people might think that's too little or too short of a period of time to refine the edge. But for us, it keeps us current in the markets. And the way we refine is very minimal. We're not flipping the edge upside down and doing anything drastic, but we are constantly recording what was the Q1 average unrealized gain, what was Q1's maximum drawdown on any one trade, what was the average drawdown, all these factors, and
hmm,
then bringing that into our system into Q2. And the result, honestly, is that every quarter the system is slightly enhanced and it does slightly better than the last quarter. Obviously there's a
well,
limit to that. It can't just get continuously better forever, but it just keeps us current with what's the current market cycle. How has the edge performed in the last 3 months? What changes do we need to make? So
hmm,
that data, again, it just gives the conviction for the new trader as opposed to relying on thinking probabilities. The edge works kind of, trust me. Well, does it? I need to see that hard data to know that it does work. And we've got that as a group.
yeah, I really like that. And I think you might be the first person I've heard with that concept of, so you review, so you forward test and review the system for the last quarter, assess how it would have performed better in the current quarters or the previous quarters regime, and then you implement those changes for the next quarter.
Yeah, exactly. Because back testing is one thing. I mean, one is very tedious as well, and also it's all kind of in hindsight, right? I know you can run simulations and live tests, but quite honestly, nobody does that
Yeah.
as the live market moves. You don't have any of the same feelings or emotion. But equally, if an edge didn't need to evolve, it'd all still be trading the turtle soup edge from the 80s or whenever it was, but that doesn't work anymore. So we
Mm.
have to evolve with the markets continuously. And by making those refinements and collecting the data is the only way we can evolve with them.
Yeah. I'm going to title this now that turtle soup doesn't work anymore, and all the ICT traders in the world are going to be
But
arguing with
here's
you in the comments. Yeah.
but here's the thing: ICT concepts, yeah, there's probably something in there that there's an edge in there, right? And it's just about working out where that edge is, and then applying it systematically, keeping record of it, and then every quarter or every 6 months refining it to stay current. I'm not sure how much I believe of like the markets run on an algo. My reference point in the market is levels, and if you trade with us, you'll see that the market responds to the levels we identify most of the time in some capacity. So if there is an algo out there, I think it's based on supply and demand concepts. But one algo to run the whole market, I think that's kind of crazy, in my opinion.
Yeah, it's ridiculous. It's like you can't, if you work, even if you don't work in industry, to think that that's true is, I think these concepts only exist in the retail world that don't kind of branch out and see, I don't know, read people like the great traders that have gone before us, like Richard Dennis or Ed Secoda, and all the people that have been hyper successful, what they did, or what investment bank traders do, or hedge fund
Mm.
traders. It's just a kind of like, I don't know. It's just good marketing, much better marketing than I do on my podcast. So I can't give out about it.
It's
But
interesting, because I was taught by an ex CME Goldman Sachs trader, and he told me really early on he didn't spend any time on any time frame lower than the daily time frame. So this was a guy that was trading the S&P 500 when it was first available as a futures contract. He was one of the first people ever to trade a futures contract on the ES Mini. So to think that there's traders or there's institutional level traders sitting on a 15-minute time frame trying to identify like changes of structure or character or whatever these guys do. And don't get me wrong, I've looked into all this stuff because it intrigues me.
mm,
Um, but it's just about keeping it simple. I think as humans, we've got this narrative: the more complicated something is, the better it is. But if you look at even companies that were built on simplicity, they're some of the biggest companies in the world, right? Amazon, Apple. What was the Apple ethos? I always remember the Steve Jobs quote of "I'm going to put 100 songs in your pocket." What a simple
yeah,
concept, but a simple system within trading. I said to you earlier, you could teach my system to a child. If you didn't bring in all the kind of asset correlation and stuff, which gives us a bit more of an edge. I've got a profitable system which is identifying a type of level within the market on the 7 FX majors that you could teach to a 10-year-old, and they could probably successfully execute it better than most adults, probably because they don't have the emotion around money at that point. So
mm, yeah. But even having all of that, right? I saw in that interview you talked about a time in 2018 when you had, I think it was a 2021 trade winning streak. So I guess at that time you had this mentality still, but you still had quite a challenging time after having a major winning streak. So can you talk a little bit uh,
mm,
about that time?
yeah, I'm actually going through something similar at the moment, and I
Oh,
talked
wow.
to my mentorship yesterday about this. So something that I find with trading is that it's outside the realms of what's normal. So if we look at any other job in the world, you don't go to work and try and be right 50% of the time. Say there are traders out there with an edge. They average risk reward is 1 to 2, and they're right 50% of the time. That's a profitable system. That's great. But there are very few jobs, like a surgeon doesn't go to work and try and be right 50% of the time. A pilot doesn't go to work and try and land 50% of the plane well. You don't try and
Yeah.
land well 50% of the time. So there's nothing really like trading in that regard. Maybe sales is probably the only thing I can think of where you make 100 calls and you might get one client. So the law
Mm.
of probability is you just need to make more calls. But at the moment, I'm going through a winning streak. So I've won 9 of my last 10 trades. And this is all within the community in the group. And we try and avoid talking about money within my mentorship because it's somewhat distasteful, but also everybody's in different situations. And if we just focus on percentages, they're interchangeable between different account sizes. But I brought up to the guys yesterday and the girls that monetarily, if I hit a certain amount, the limiting beliefs every month stop me from pushing to that next level because of how I've grown up and what I deem to be a lot of money. So there's an element of psychology that comes in with the figures that you see, and no matter what you do, you can't get rid of that. You can hide your P&L and stuff, but you're still going to check it. Um, and this month's been a particularly good month. So we're only on the 22nd of the month. We had a euro dollar setup line up yesterday, and I under risked. It's everything I need to see, but I under risked on the trade. And I openly said to the group, I've under risked because I'm from a monetary standpoint, I'm at a position where I've made a lot of money this month. So I just want to add a little bit to that. I don't want to lose any of that, And so even now, I still have those battles, and I
Yeah.
think you're not human if you don't have those. I've got a couple of guys in the group that don't have them. They are just robots, so I think it's a different mindset entirely. But yeah, I still have it.
Hmm. How do you manage it then? You just open about accepting it's a belief that's there. I first of all completely relate to that. I think people that haven't gone through that haven't seen a P&L in the bottom right corner that could make a material impact on their life. And once they do, they realize pretty fucking quickly. It's like that then
Yeah.
things start playing on your mind. That's a holiday, that's a ring, that's a wedding, all these kind of like you might have guessed what's on my mind at the moment.
Yeah.
But you know what I mean. It's those things that cross over into your lifestyle, how they can impact.
Of course. Yeah, absolutely. But I think those limiting beliefs are what stop you getting to that next level. And so, firstly, just identifying them and being aware of them is the first step, right?
Mm.
And because I write down a lot, so I've got a notepad here to my right hand side, and anytime anything happens in the market, I this isn't part of my data collection. This is just me rationalizing what I'm seeing. And sometimes I'll write in there and I'll realize actually, no, that's not what I need to see. That's not part of my trade plan. But yesterday, equally, I wrote in there that I under risked. And then it was kind of a case of, well, why did I under risk? Well, because I'm up X amount, and that to me is a lot of money. But to the trader that trades £500,000 a point, that's not a lot of money. So how do you break to those levels? And I think it's just a case of, for me, it's always been about just doing the thing more. So we get to a point maybe next month or today. I'm back at the screens again. If a setup comes our way today, I take it at full risk. I need to make sure that I rectify it as quick as possible and just keep doing. And if I don't address it, why didn't I? And keep working on it that way. But for me, it's about volume. Just do more. The same with the edge. The more trades you have recorded, the better you can refine the edge.
Yeah, I really like that. I think it's simple, but also the advice people probably need to hear. It reminds me of Ralph Waldo Emerson, the poet. Do the thing and you'll have the power. It's so simple.
Yeah,
It's like, oh, but it makes so much sense. And you're right to relate that to, say, different person might think that's a small number, but just because of your beliefs. And I think these are like the kind of raw truth about leveling up as a trader that people don't really talk about. They just talk about, unfortunately, strategies all the time, and we'll talk about it too. But I mean, that's just the first thing people run towards, or they haven't got a strategy, but they want to be a full-time trader. And this is
yeah,
something
sure,
a
yeah.
big one I've got, yeah, or haven't gone through it, but then that's their goal. So I mean,
Mm.
I know you went through that transition, and you had a period of time where that trading was your full income. So
Mm.
what was that transition like for you going into it?
That was tough. That was really tough for me, actually. I think I talked about this previously on a podcast, but making that jump and suddenly then being fully reliant on trading as an income completely screwed up my psychology.
Mm,
And it was kind of one of those things that I thought, I've got this down now. And I think each stage in my trading career, as I've scaled up or leveled up or had more assets under management or whatever, has always been almost like starting again. It's like everything you've been doing previously goes out the window. And all of a sudden, now I'm fully reliant on the income. Or we get to the 30th of the month and I'm deviating from the plan because I haven't made what I wanted to make that month. And you really can't trade like that. You trade what the market gives you, not what you want to take from it.
mm,
So it happened again to me further on in my trading journey where I managed a MAM account, and it was linked to all the clients' accounts. So every time I took a trade, it was mirrored onto their broker's account through the same broker. Broker would pay us as through a separate company.
mm.
And it all happened all over again. I hit first month I did it, had a huge winning streak, doing really well, loads of positive feedback, great income for the month. Second month was a losing month, and then kind of everything went out the window on that second month. It's like I don't want to do this. This is too stressful. I don't want to manage all these people's accounts. Um, so it was again another stepping stone towards, I guess, the psychology or the mentality that I have now, is having gone through all that stuff. And when I see the new trader come in and join the group, and I see them doing all the same things, I just try and rationalize it for them and say, look, everybody does this. I did it. Just keep going, keep pushing through, because naturally they go, do you know what? I don't think this is for me. I'm not suited to it. I can't. You've got the edge. I trust the data. I see it working. I see everybody taking the profit, but I'm screwing it up. And you have to kind of remind them, yeah, don't worry, I screwed it up for years. It
Mm.
took me it took me 4 years to get this right initially, and others I've heard it takes them 10. So some people get take to it quickly, other people, and I think the ones that take to it quickly are few and far between as well, right? I don't know if you'd agree, but there's very few people that don't have to go through all those hardships. And someone actually once said something in my mentorship which was really good. She was very very successful in her career, and she said, God, I thought I knew myself until I did this.
Mm.
And it's
Wow.
like it brings out all these things that you didn't even know were there subconsciously. Self-sabotage, your view on money, your relationship with money, um, all those kind of things. They just come out in your trading, and they're like there for you to see because they're in your P&L. And it's
Yeah.
like, you're doing this, you didn't realize you do that, but that's what you do in all your life. And I'm showing you right here, that's what you're doing.
Yeah, yeah. That's so true. It's like you don't know yourself until you're losing money, and then don't look in the mirror because it's not always nice. But when
Yeah,
you were managing those people's accounts, it's an interesting perspective because I know people that have managed other people's accounts and they said they would never do it again. But
sure.
did you take that as that kind of opportunity to get through a level in your trading and you kept doing it even though you had the losing month, or did you just say I don't want to do this anymore?
Um, No, I didn't continue to do it. I did it for a certain period, so I did it for a good 6 months, I think. Um, but it was more so because, from a business perspective, it made sense for me to move away from that at that point and go out on my own.
Mm.
Um, Obviously, I'm not a money manager, so I'm not taking on funds in my own account and managing people's accounts. The only way I could do that back then was through the broker's software. So they'd have copy trade
Oh, sorry.
software.
Yeah.
Yeah,
Yeah.
so it was slightly different. And then obviously we saw the evolution of the retail prop firm. I don't like to really call them prop firms, but that's what they call themselves, with simulated capital. And this whole thing opened up, and really inside my mentorship, that used to be a barrier to entry for a lot of traders. How much do I need to get started? Well, nowadays actually you can make a pretty reasonable income, and I've got people doing it, and I myself have been paid by prop firms many times. Is you can jump in with €450 to get $100,000 simulated account. And provided you go with a reputable firm, you can make money. And I noticed people actually in the mentorship, they put that on a pedestal. For me, it's always been the other way around. It's like, okay, these prop firms are kind of perhaps a bit shady. There's not always the best feedback on some of them on X, on Twitter, and I see it as like, well, it's only €450 for $100,000, quite commonly around €500. So it's essentially a €500 risk. It's not $100,000, but a lot of people in the mentorship, they see it as $100,000, and they put it up here as like, this is going to change my life. This will change everything. So I see
Yeah.
them go through the same battles that I went through in managing those accounts through the broker back in the day. Exactly the same thing. It's like, I think we all go through it. You go from demo to then live account, and it's like, oh, it's suddenly very real now. It's a live account. And then maybe you go on to a prop firm, or you go on to a slightly bigger live account. And each hurdle that you go over means that you've almost got to reset your psychology and start again. That's how I felt, or I found it anyway.
Yeah. And yeah, because I agree that they are not prop firms, but a good resource these days for people, a new resource, something that didn't exist, I don't know, 3 or 4 years ago, and or in the mainstream exist. And I do find with them, I said they can be a little bit shady, and you're only as big as your max drawdown, in my opinion, with these accounts. So when they have a 10% max drawdown, it's people get quite intimidated by a 100K number, but in reality, you've 10K free capital, and that's your size. You can scale it, but initially that's your size. I think they're quite good for taking income out, but I think you kind of made this point. Sorry to say, I think about 4 times there, right? But yeah, they're not the final kind of solution. I think they're great to get money out of these firms, but really the goal, I often think, is they should be a supplement to a full time or just a normal trading account.
Yeah, absolutely. My opinion is, without going into sort of tax implications and stuff in a podcast, but my opinion is you could leverage prop firms as much as possible to get as much money into a spread bet account as you can. That's always been my view on it. Having said that, there's traders within the mentorship pulling in six figures a year from the reputable firms.
Well,
I've got a couple of guys in the group at the moment that have last year cleared six figures with the top firm in the industry, without naming any specific people or companies. So it's there for the taking. If you're a profitable trader, you have an edge. I saw something yesterday. Actually, somebody was asking, do you trade them the same way as you trade your personal accounts or a real money live account? And going into that, I think in the challenge phase, probably not. It's you can be a bit more flippant. You've got to hit a number to pass. I don't trade my personal accounts to hit a certain number by a certain time or anything like that. So not in that sense, but an edge is an edge, right? If you've got an edge, you just need to execute it. If you start messing around with the edge to accommodate the prop firm, you're messing around with something you don't know the results of. If you've got an
true.
edge, you need to execute that edge exactly as the data specifies. If you deviate from that at all for some prop firm challenge or whatever, then you don't know if the edge is gonna play out and work in your favor. So in a sense, I think, yeah, it's the same way. You need to execute the edge efficiently. Maybe you can tweak risk, so you're going in perhaps slightly bigger risk if it's a trading challenge, because you've got to trade. If you have to trade it for 6 weeks and it takes you 6 weeks to pass, you're trading for 6 weeks for no income because it's a trading challenge. You're actually €500 in the hole or whatever you paid for the account. So yeah, in terms of risk, yeah, I gave myself my own question there, but it was just something something I saw yesterday
Good
on
question. Yeah,
LinkedIn.
yeah.
Yeah, yeah.
Maybe you should have your own podcast, I think, and then
It's just
no, but
something I
it's
read.
yeah, yeah, no, absolutely. Um, but I mean, the concept of edge now has come up quite a bit, and I think we probably talked more off camera about your edge than we have done on camera. But just to go back to your trading strategy at a high level, you know, in a kind of one liner, how would you explain how you trade?
I trade supply and demand concepts. So, very simply, with cross asset correlation. So, I'm always looking at what's driving the move, why we're at a certain level, when we're at a level. And I predominantly do that in the Forex markets, in the currency markets on seven major crosses. I do look at a couple of other things as well, which would be metal. So I look at gold and silver. I'll look at crude oil and a couple of indices as well. But my my strength is within currency markets because I feel like I can identify why a move is happening much easier on a currency pair than I can on, say, something like crude oil, because that could be risk driven. It could be money going into stocks, and inadvertently then crude oil is rallying, or it could be something to do with OPEC, with tariffs, with um, Canadian dollar, even potentially. There's a lot of things that can influence it. With currency, I find it a lot more streamlined. It's much easier to identify where the moves come from and why it's happening. But yeah, in
Yeah.
simple terms, it's supply and demand concepts, which is just key levels within the market with cross currency, cross asset correlation.
Hmm. And when you're identifying these moves, right? So say in FX, how do you try and find the root cause of a move?
So if I'm trading FX pairs, they're all dollar crosses. So I've got several screens here in front of me, but on one screen I'll have the Dixie. So I want to see, is the move that I'm looking at on, say, euro dollar to do with the euro or the dollar or risk? Because people draw analysis on a chart, and this actually going into sort of FX minors. If you're to draw analysis on something like euro yen, there's so much that can influence that currency. But people think because they've drawn their analysis here that the trade should work. But without knowing why we're moving or what's put that currency pair where it is at that point in time, it's very difficult to say whether the analysis is going to work. Because
Hmm.
if it's let's say we take euro dollar, and we've got a strong dollar rotation, dollar's selling off hard, so euro dollar is rallying. Euro dollar is highly traded or heavily traded. There's a lot of volume going into that as a dollar pair. So if you had something like euro dollar and pound dollar as another highly traded dollar pair hitting a level at the same time, an area of supply, the edge there is that you're stacking the odds in your favor for that level of supply to hit to work, because you're looking at the two most traded dollar pairs. You've identified that the move is a dollar rotation. It's coming from dollar weakness. They're both hitting supply at the same time. There's an edge there. That's how my edge is built,
Hmm.
and it's very profitable. Even high strike rate positive are profitable. But just going back to the euro yen sort of analysis, you're drawing some analysis on euro yen. Let's think about what could influence that. Well, the yen's often seen as a safe haven, so there's risk. There's the Japanese index could be driving the yen. There's the euro, could be driving the euro in that pair. There's also the dollar, because sometimes the euro just inadvertently moves inversely with the dollar. There's so many different things that can move that currency. So just drawing some analysis on it really doesn't mean anything. The chances are the institutional money and the big money that moves the market is moving it through either the majors or what's driving the move. I think the other thing to consider as well is, like, we're in a risk off environment. Everybody's pulling out of their pensions. There's a panic selling going on. People are saying to their financial advisor, get me out here. This is looking bleak. Everything's looking risky. Why is your level on euro dollar going to work? The financial advisor didn't go, no, no, we can't take your money out here. Euro dollar's coming to a nice area of demand or supply.
Yeah.
It doesn't make sense. It doesn't make
Hmm.
sense to have analysis on those things and expect it to work when something else is at play at moving the market.
Yeah. And to take that euro sterling example, so you're looking at euro dollar. and you're looking at cable, and you see dollar selling off in both scenarios, or the euro and sterling both rallying, and you find out that's because of this new European defense spending or something like that, and there's some rotation out of the USD. So once you have that as the root cause, then you look at your chart and you have these supply and demand zones. So without getting into too much detail, what's your approach to finding kind of high probability supply and demand areas on a chart that you'd frame that around?
So the higher time frames being one. So I don't go below a 4 hour time frame. I would occasionally look at a 1 hour time frame in rare occasions if I had something on the higher time frame setting up on a different asset that's correlating. So say we've got a cable level and I've got nothing on euro dollar, but I go down to the hourly and actually I can refine something there, and maybe there is something, gives that little bit extra weight to the cable level. But predominantly we spend all our time on the daily and the 4 hour timeframes. So there are a few traders within the group that just trade the daily levels. So they don't look at the 4 hour unless they're refining a daily wick or something like that.
Hmm.
And there are other full-time traders within my community that trade the 4 hour time frame as well, just because they've got the ability to look at the charts more frequently.
Yeah.
But a strong level comes from the higher time frames and price as well. I use price. I use round numbers.
Hmm. And the because I'm trying to remember traditional supply and demand, how it works. But I know I've seen some probably TikTok videos on how you do it badly. But generally, it's like, say if it was a demand zone, it's a red candle lower followed by a strong green candle, and then that red candle becomes a demand zone. Is it?
Yeah, it can be. I mean, it could be seen as a demand zone could be formed from what you'd see as a drop, a base, and a drop. So the base there
Mm.
becomes demand because there was a
Yeah.
stall in price action, or a drop, base, and a rally, which
Mm.
obviously forms a different type of demand. But equally, I treat them both the same. If you've got demand on the 4 hour and it's not visible on the daily, so I get this question a lot. Obviously, the demand is stronger on the daily. No, it's not really. The demand is strong when everything lines up.
Mm.
It's not necessarily to do with whether it's on the daily or the 4 hour. We recognize there's an edge within both of those time frames, and that edge plays out more often than it doesn't when the assets start to align, rather than just saying, well, the strongest levels on the daily, the 4 hour's a bit weaker. Actually, the 4 hour can be stronger than the daily if everything lines up at the same time.
Because you're a guy, grounded in a lot of statistics, you must know kind of your edge backwards, or at least the last quarter's kind of edge. So when you're putting on that risk, do you have a kind of trade management plan you use, or do you increase risk, or do you other times you decrease risk, or are you entry and then end, close the position, move on?
Yeah, yeah. So I'm entry. It's stop loss or win. There's no break
Hmm.
even. There's no moving stop loss. When I took the trade, I'm happy to risk X amount, X percentage. Therefore, if the trade starts to go in my favor, why has that changed? Why do I need to then protect X percentage? The only reason I think you move stop to break even is fear of a winner turning to a loser, right? And I just try and eliminate that as much as possible. But one, it's another variable to log. So how many times did the trade go into X amount of pips profit before going back to break even? And that's a time consuming variable to log on every trade as well.
Hmm.
If we know that the system has an edge and we know that the system has a certain expectancy, 70% of these type of trades work and they do 1.5R 70% of the time, let's say.
Hmm.
Why do we need to move the stop to break even? Why do we need to tamper with that trade? The only thing we need to look at is how much drawdown did these trades do on average, and what was the unrealized gain from these trades. Because this is a good example in Q1. we found that we were taking quite commonly 1.5R on trades. And I actually kind of reset the whole data collection process for the community this year because I wanted everybody on board. There were some people that weren't doing it adequately. So as a result, everybody came in to do the data collection together. And I said, log every trade and take it at 1 to 1R or 1 to 1.5R. Ignore the result, it's completely irrelevant, but let's log how much unrealized gain there was and what the drawdown was. And we actually found on average, every trade we pick on average was doing 2.3R. So 1 to 1R is leaving loads on the table, right? So then we'd increase the parameters for Q2 and target 2.3R per trade and so on.
Mm.
But logging all that data is just so important. I don't know how a trader can get by without doing that. I mean, obviously some are, but I don't know for how long.
Hmm.
I don't know.
Yeah,
Are you data driven yourself, or do you not find it that's something you do?
no, I definitely am now, but it's as I move towards the more systematic signal before I
Mm,
engage with a trade. So the shift I have moved is, using a technical strategy that you back test, or I use Pine Script, which is like basic bitch back testing, but it gives me statistics around of how the strategy behaves. That gives a
mm,
signal, and then you assess things like the regime, maybe the cross asset flows. The things are a
mm,
little bit softer that are hard to capture systematically, and then you trade. But but yeah, I think I am definitely guilty of not logging trades after the
mm.
back test, as in forward testing them or doing a period of forward testing.
Yeah,
And
sure.
I really that idea that you've brought on there, that of refining that edge quarterly, really like that idea. I think it's something that I haven't heard people talk about openly anyway,
Mm.
and something for people to take away.
Yeah, it's funny because when I spoke at the expo last month, I was talking a bit about discretionary versus mechanical edges and
Mm,
how a mechanical edge suits the new trader so much better because there are a number of speakers at that event that are like 30, 40-year veterans in the game. And they could maybe teach you their concepts or how to trade, but realistically, are you going to be able to learn that? They've got 40 years of experience that gives them discretion. There's so much subjectivity to their system because they're
yeah.
using experience and the time they've had in the markets.
Mm,
So the fast way to teach a new trader is a mechanical system. Obviously, there are elements of discretion within that mechanical system, but largely it's mechanical.
yeah.
It's a tick box process rather than being a um, I think it's going to go here because I have a bias. I went through some charts with people and I said, like, what's the daily bias here? And then it was a clear one: trend, uptrend. Daily bias here, clear downtrend. Then I put a couple of charts in that were more subjective. It was like, what's the daily bias here? And there's like this quiet murmur in the room. It's like you can see that the seasoned trader here would say maybe it's an uptrend, but you might look at this and see a downtrend or consolidation or whatever. So
Mm.
there's all these elements of discretion that come into a system that's based on experience and time in the markets. It's really hard to teach that to someone that's early in their journey.
Yeah. Yeah, and because I had that exact problem. I feel like this is kind of a mirror interview of me when I was starting, right? Because you brought up a lot of concepts that I've gone through, and I think when you knew you gravitate towards people that have that experience level, 30, 40 year traders. Like my ex mentor is a 40-year investment bank trader, and now he runs a fund, but
Mm,
he trades exactly like that. It's like a 40-year library in the back of his head that he's pulling from. And when I'm there thinking I want to be short dollar yen, and I'm reading some central bank speak or whatever that's probably already in the price, and he's already made 50 pips off of, and then I'm thinking this is going to be my base case, and it does
mm,
leave you somewhere between a rock and a hard place without that mechanical system. But I think that, and the point I took from Michael Taylor, who was on the podcast last, was, starting with the mechanics and with the market, and say in your example with the levels,
mm,
it's the market telling you the level. You're not telling the market what you should be trading. You're letting the market tell you first. And then you can, as someone said to me recently, systemize the discretion, get the signal if you have discretion or you're able to bring it in, and then
Yeah.
decide whether you take the trade or not.
Yeah, I think a lot of mentors hide behind that discretion, that subjectivity, because
Mm.
one, you could say to them, this fits the system, why aren't we taking it? And they say, well, I don't really like that. Okay, why don't you like it? Well, the true answer is because I've been in the markets for 30 years and I don't really like the look of it, but
Yeah,
how
yeah,
do you translate that to the novice trader? And then the other thing is, the scammy mentors that hide behind discretion because they say, well, no, I didn't take that, but it's all in hindsight and it was a trade that lost. Well, why didn't you take it if it's the system? Because of this. And you can always make a reason up. There's so many dynamics at play within the markets at any given moment. You can always say something and then people latch onto that, trying to learn that, he does this or she does this when they're taking a trade. No, they don't actually. They were just fobbing you off because the trade lost. And then
yeah,
that leads people down the completely wrong path of trying to learn how to trade. And
mm,
they'll just think, why am I not getting this? They can do it. Why can't I do it? But the reality is, one, maybe they can't do it, because we know that certain social media platforms have bred a huge number of mentors, selling courses with no experience at all. So one, maybe they can't do it, but equally, if they can, it's coming from years of experience, on the more professional platforms, or going with a mentor that's 30 years in the game.
yeah,
They can teach you so much, a mentor that's been in trading for that long. But the one thing they can't teach you is that element of discretion, that their thought process. You almost can't put it into words, right? It just comes from experience, comes from time.
yeah, yeah, exactly. Yeah, which
Mm.
is a challenge for new people. Um, but going back a little bit on statistics before we finish up, right? The average kind of time in a trade for your process and your edge, how long are we talking about? Is it multi days?
No, no, it's not. To give you an example, I've taken so the three trades this week. So we're now Thursday, right? So Monday was a pound US dollar sell. It was closed within 3 hours 40 minutes. Yesterday was a euro dollar sell. I mean, bear in mind the market's been going up all week, but it's those two assets have been going up this week, but it's just based on coming to areas of supply. We
Mhm.
were in and out of that probably within 2 hours, and then uh, Kiwi dollar last night was probably entry was somewhere around the four, maybe a bit later, perhaps I want to say 5 or 6. I need to look at my history, but that was closed pre-spread, maybe 8:30, 9 o'clock. So typically, that's the kind of length of time. There's the occasional overnight hold if a trade's taken late in the session,
Hmm.
but a few hours. A trade, as you know, the market can move very differently one day to the next. A trade can last anything between 20 seconds to 6 hours, or an overnight
Yeah,
hold, even.
yeah. And my last question is, when you're trading on that time frame, right? So I guess intraday or multiple hours, how do you help people in your mentorship approach risk management and sizing?
So I'm ultra low risk. This is a flaw, I think, of the retail industry here. It's a good question, actually, because you'll commonly hear don't risk more than 1% a trade. Well, I've run Monte Carlo simulations on varying strike rates and things. So let's take a prop firm. They give you a retail prop firm. They give you a 10% drawdown limit quite commonly, or sometimes 8. But let's say 10%, and you've got a win rate of 30%, but your average R is 1 to 5. So that
Hmm.
system, 10 trades a month, 120 trades a year, that system will give you an expected return of around 48% at 0.5% risk of trade. So I can't remember the exact number off the top of my head, but the average number of continuous losses in that system is somewhere around the 11 or 12 mark. The top percentile is like 28 losses. in that
Wow.
simulation. So
Mm.
there's two things with that. One is that the new trader is never going to stick that out. They're going to hit a string of 6 losses, 7 losses, 8 losses quite commonly, and they're just going to go, this doesn't work. The conviction comes from seeing the system work.
Mm.
Also, if you're trading at 1% risk a trade, which is deemed good risk management, then if you're losing 10 trades in a row, that's it. You've blown up. You've lost the trade account, the prop firm account. Also, minus
Yeah.
10%. That's pretty hard to deal with when you're trading 1% risk a trade. That's pretty hard to deal with for the new
Yeah,
trader.
it's a long way back. Yeah.
So I ran the same simulation on a 1 to 1.5R with a 75% win rate, and the return is 52% with the same number of trades per year. So it slightly outperforms, but it's roughly the same. But psychologically, the average losing streak is 4.6 trades.
Mm.
So now all of a sudden, trading with a slightly higher win rate but lower risk reward is giving that trader more of a psychological edge because they're not hitting those big drawdown periods. They're seeing the system work. Therefore,
Mm.
they're building conviction. But equally, I think personally, if you're going in at 1% risk of trade, 4 losses in a row, you're 4% down. That's a little bit of a hole to start climbing out of on one of these prop firms that only allow you an 8 to 10% drawdown limit. You're potentially already nearly halfway there or halfway there.
Yeah.
So everyone in my group, I encourage them to trade at a 0.25% risk per trade, which might seem incredibly low. And I've even had some traders in there trade at 0.1% risk because I think it builds a little bit more mental strength and it gets them seeing the system work. The benefit there isn't the money they're making. The benefit there is that they're seeing the edge play out in real time, and that if they just bump the risk up slightly, before long, they're making good money. I think there's a common thing within the retail industry. I've heard 2%, don't risk more than 2% a trade. That's huge.
Mm.
What's your win rate? If your win rate's like 50%, you're going to go 20% drawdown, almost guaranteed at some point over
Yeah.
1,000 trades, So I think we have a tendency within the retail space to take risk too high, and it comes from people trying to get rich quick. This can change my life, etc., etc.
Mm. That's a fantastic answer. Very similar to what Rob Carver said to me about, risk management should be based on your trading system and understanding it, which very nicely brings us back to your first point about the importance of having statistics and understanding your system. Because as you said, 0.25% might seem low, but if you're trading every 2 hours, or your trade duration is 2 hours, then that could be seen by quite high or less optimal depending on how your system works, right? So, yeah, I think that's a super answer to think a little bit more nuanced about these concepts and not just stick to the common put 1% down and then hope for the best.
Yeah, I love that. Knowing your system, it's just
Mm.
essential. I've got everything. I couldn't remember the exact numbers there, the consecutive losses in a row, but I have a rough idea that, for example, with a 75% win rate, a 5 loss losing streak, there'd be 95% of 10,000 simulations that we hit that 5 trade losing streak on. So
Yeah.
when it then happens in real time, you go, well, I knew this could happen. I've got the data to say it could, and you don't start questioning the system and going, oh no, what am I doing wrong? Or do I need to tweak the edge here? Or do I need to find a new mentor and jump to another group because this one's not working? You actually know the data tells me this would happen, and here it is.
Hmm.
So you position size according to that.
Yeah, absolutely. Daniel, it's been a real pleasure talking to you. I've learned a lot. I personally have lots of things to take away and a standard of logging data that I need to get to. But I really appreciate your time and thank you for coming.
Thanks, Colin. No, I really appreciate it, mate. It's been good.